The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The fight over the cost of capital, live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick.
And I'm Isabel Lee. We're kicking you off to the closing bell here in the U.S. on this Wednesday, and markets are staging a rebound. That's after the Treasury announced plans to boost buybacks on longer-dated bonds. This is a signal that the U.S. wants to lower borrowing costs after yields hit all-time high. You're seeing the S&P there inching higher by 0.3%. We're seeing more gainers than losers, but chips are the biggest losers, down by 2%. U.S. 30-year yield holding steady at 5.1952, and we have the dollar hitting its lowest in 3 months, Romaine.
Let's go back to that Treasury yield, because Scott Bessent, who 9 months ago famously said that it is his job to be the nation's top bond salesman, and that Treasury yield would be the barometer for measuring that success. Well, let's just say he's struggled quite a bit of late. The day he gave that speech to a Treasury market conference back in November, 20 and 30-year yields were below 4.7. Today, they're around 5.2% and would be even higher if not for Bessent trying to cap the rise by lifting the cap on his agency's buybacks for longer-dated nominal coupon securities.
The market reaction suggests that this is an important tactical move from the Treasury, a little bit unexpected, so you're probably getting an outsized reaction right now. But I don't think it changes the fundamentals of big fiscal deficits and a Fed on the sidelines, which is what's driving longer-term yields higher.
That last point is key, because many traders seeing this as more of a Band-Aid than a true long-term salve. After all, the fiscal deficit, the relentless Treasury borrowing, and of course those lopsided durations, add in the broader concerns about inflation. That is putting the floor under yields that will now test Bessent's attempt at a cap. Exhibit A, you take a look through those released minutes of last month's Fed meeting and pay close attention to the tone of some of those FOMC policymakers. The other bugaboo out there is that government bonds now occupy a much smaller place in portfolios than a decade ago. Private assets continuing to shape out more of that 40 of the old school 60-40 portfolio, and the public market deluge of AI-related corporate borrowing, well, that's not going to help the Treasury's case anytime soon. Hyperscalers, Isabel, continuing to flood the market with record issuance. Definitely
a flood of records. And I want to bring you to this chart. So the white line shows corporate yields, which have stayed elevated, as you can see here. And then the blue line shows longer dated investment grade bond issuance, which are debt maturing in 15 years or more. So what is the takeaway? That the AI boom is creating some competition for its own equity trade. You're seeing tech companies borrowing heavily to fund the AI build out. And that's really creating attractive opportunities in the bond market, especially further out in the curve. You see here, tech now accounts some 40% of U.S. IG issuance. That's according to Goldman Sachs, with some AI-related debt yielding around 6 to 7%. So investors have a choice: take the equity risk, Romaine, or lock in relatively high yields from the very same AI boom. Well, let's kick things off with Sitara Sundar, head of alternative investment strategy over at JPMorgan Private Bank. You know a lot about this, and I think the last time you were here, we talked a lot about sort of the AI infrastructure financing and how much of that is actually coming out of private markets rather than public markets. So let's face it, I think both are kind of sharing the burden here. When it comes to how that's being received, is the activity in the private market more representative of demand for some of this AI financing as opposed to what we're seeing in the public space?
Look, I think that when we take a full step back to think about why there's this amount of issuance, whether it's in public markets or whether it's in private markets, it's because we are still in a period of time where we're trying to solve for the bottlenecks on the infrastructure side, whether that's the power side or the compute side. So the way to be able to invest in that is, for the most part, people are trying to issue that and raise that capital through debt markets. What we think in terms of the next 5 years is that a lot of that issuance is going to come from private capital. So 25% of the multiple trillions of dollars that we expect to see over the next 5 years is going to come from private capital. The tension that is taking place right now is not that there's not demand, because their bids are continuing, but it's whether I'm getting compensated for the risks that I'm taking. So what do I mean by that? For the most part, there's a lot of infrastructure-oriented funds that are investing within data centers today and are getting the bid for a lot of those loans in the issuance, whether it's on the equity or the debt side. But the difficulty that we always come back to when we're thinking about it from an investment perspective is, am I getting paid for tech obsolescence risk? Is infrastructure-oriented returns, especially within the data center space, call it high single digits to low double digits, is that enough to compensate me for the fact that maybe some of these data centers, depending on where they're built, whether there's training or inference or where they are in that value chain, is that compensating me for the risk? And that's the question that I think we're trying to answer and investors are trying to digest.
Curious, because certainly in the public markets, you see that kind of playing out, particularly when you see sort of an issuance come from a Nebius or a CoreWeave or some type of issuance from a NeoCloud or somebody that maybe doesn't have quite the moat that, say, an Alphabet would or an NVIDIA, picks and shovels type play would. So I assume that's all playing out in the private
the spreads
space.
Are the higher spreads are there in the public market. You're seeing that same thing in terms of compensating for the risk on the private market
Do you
side.
think we're going to start to see those spreads kind of widen out a little bit more? Or are we getting sort of close to some sort of equilibrium?
I think that we're going to continue to see the spreads reflect the risk that is embedded in any type of investment that is related to artificial intelligence. We're definitely seeing that on the infrastructure side. The other way to think about it is the tension that markets are trying to digest at this point in time is like two different trades that are getting priced at the same time. One, it's whether or not the infrastructure players were actually starting to see whether or not the cash flow burn that is being taken to build a lot of this infrastructure, whether that's compute, whether that's data centers, whether that's chips, whatever have you, whether that's even grid infrastructure, whether that payout is going to end up coming on the application side. Because at the end of the day, we're building all of this. The hyperscalers, the public and private markets are building all of this infrastructure in the hope that artificial intelligence is going to become this platform technology that moves beyond just the tech sector in terms of ROI impact, and it's going to move to the services businesses too. So right now you're seeing markets try to price that.
What about private markets? You say that they're a strategic necessity. Is that maybe a conviction call, or are investors just being pushed towards that illiquid investment because public market valuations are maybe too high?
Oh, this is my favorite question. So I think that there's two different things that I think a lot of the activity that we've seen so far this year, whether it's in terms of what we see on the long end of the yield curve so far in today's price action, and more broadly, which is that the market is trying to figure out, and investors are trying to figure out, what the next phase of artificial intelligence is going to be and what the ultimate impact of geopolitical fragmentation, what that means for rolling supply shocks to inflation, and what that ultimately means for stock-bond correlations, because we've usually seen when inflation volatility is higher, stocks and bonds move in that same direction. So when we say that private markets are a strategic necessity within client portfolios, they fill two different buckets. One, it's trying to access alpha return drivers beyond just U.S. mega-cap tech, because that is what has dominated public market performance over the past 3 years. That's private equity and buyout, that's secondaries to a certain extent, and that's VC and growth too in terms of legging into those next-gen disruptors. But it's also on diversifying the diversifiers. What that means is that your 40 part of your portfolio used to be, I'm trying to find yield, I'm trying to find carry in an environment where rates were low. Rates are no longer low, but now the ultimate question is, where can I get yield that is going to survive after inflation volatility? That's where real estate, core real estate comes into play. That's where infrastructure comes into play. And that's where non-directional hedge funds, especially despite July's performance, it's been a pretty strong year so far this year for hedge funds in terms of providing less correlated return streams where you're able to get alpha generation without sacrificing a volatility benefit.
All right, Sitara, great stuff. Got to leave it there. Sitara Sundar, head of alternative investment strategy at JPMorgan Private Bank, kicking us off to the close here on this Wednesday afternoon. A closer look at one of the biggest movers of the day, and that is Estée Lauder, a turnaround apparently starting to take root. We're going to catch up with the CEO in an exclusive interview to find out what exactly he sees as the next leg up.
Plus, from beauty to bonds, we'll break down the twists and turns in the Treasury market with Greg Peters, co-CIO of Public and Private Fixed Income at PGIM.
And we're also going to catch up with the former CEO of Walgreens Boots Alliance, Brewer, on her storied career and a big question about, well, what comes next for her in the C-suite. All that and more coming up next, right here on The Close. This is Bloomberg.
Let's track the AI spending boom through the lens of financial technology. Our next guest's fintech platform is rapidly building out the infrastructure to manage its customers' AI spend. Today, launching Ramp Router, which works with major AI models to manage costs. Joining us live, I'm very pleased to say, is Ramp co-founder and co-CEO Glyman. Eric, thank you for joining us. So, AI spending, it's up 21 times on ramp. So are companies actually getting a return on that spend, or do you think that they're afraid maybe of just falling behind?
It's, I mean, what you just said, I think bears repeating. Over the last 12 months, companies are spending nearly 21 times more on a line item. Never in the history of business has something grown so quickly. And I think there's two realities. Part of the reason for that growth in spend is there are these moments where you plug in AI and it is just extraordinary returns. But the fear that a lot of businesses have is, are their employees just token maxing and spending too much? Maybe they spend $15 when really they could have spent 15 cents. And what Router.com, Ramp Router, is aimed to do is help companies not need to worry about that. And companies adopting it are already saving 40% on their day-to-day queries.
And you just raised money at a $44 billion valuation. What does Ramp need to do to justify that value?
Well, for us, our customers are seeing that value every day. We launched the business just shy of 7 years ago, and already more than 3% of all the corporate card transactions in the U.S. And about 1% of all corporate transactions across cards, bill payments, and AI spend is going through Ramp. And I think for me, it comes back to what are we delivering for customers. Last month was the first month that we actually helped our businesses spend over $1 billion less than they would have otherwise. And I think it comes back to, for businesses that adopt Ramps, are able to cut their spend by over 5% per year. And I think if we can keep helping customers save and keep taking more of the market, investors, I think, will continue to be very excited.
I know there's been a lot of talk about a potential IPO up ahead. I do have to ask you, though, about that $44 billion valuation, because obviously you had Navan come to market recently at about a third of that value. I think, what was the other company? Brex got bought out by Capital One, who I think you're familiar with, at a valuation that was basically a fraction of what you are. What justifies $44 billion for Ramp?
Yeah, it's really just the core of it.
Yeah.
We're generating multiple $1 billion a year in revenue, which is meaningfully larger than both the other players that you named, and we're growing dramatically faster, over 100% per year. And that rate of growth has accelerated last year and the year before. And so it's really unusual to see that level of growth at this scale. And meanwhile, as fast as we're growing, there's still businesses that are comparable that are larger. American Express is a $230 billion company. JPMorgan Chase is nearly $1 trillion company. And so 44, well, it sounds like a lot in the grand scheme of things, is very small for the value we think we can bring to customers.
I mean, it's kind of interesting, though, in this space, because I was looking around. You're kind of like one of the few, like, kind of independent at scale players in this space. And I guess it raises the question as to whether you'll stay independent, particularly given you sold your last company to Capital One. Capital One just bought Brex. You know, there's going to be a lot of speculation as to exactly what your next step is. What is your next step?
Yeah, I mean, for us, I think that's part of why we're so valuable for customers. Like, I hope this is the last business I ever work on. I think in a world where computers can think, many businesses out there are wondering, why am I doing my expense reports by hand? Why am I paying bills by hand? And being able to go with a company like Ramp, which is committed to being independent, means that businesses can know that pace of innovation is only going to continue. It's not going to be slowed down by M&A the way that this is happening at other companies. And so I think the proof is going to be, do we continue to deliver for customers? And I think Router.com is another great example of this. Going
back quickly to the AI spending, are CFOs or co-CEOs becoming more worried about the huge amount, the billions of dollars being invested when it comes to AI, or are just they really willing to spend whatever it takes?
For CFOs, it has been both a deep area of excitement, but also a bit of a nightmare. When you think about it, it would be unreasonable to operate a business today without a software to run your payroll. It would be unreasonable to run without software like Ramp to pay your bills and vendors. And there's this major third category of spend, which is AI emerging, and yet basic things like accounting for AI spend. Most folks are accustomed to, you get a bill for $300,000 with no line items. It's hard to split up by department and location. And part of what Ramp is able to do through our token spend management and Router products is make the accounting for that easy, being able to delineate where is return on investment, and then tools like Router.com, which help CFOs automatically route to the right model for the right task. That way, when you need the most advanced model, we'll route to it. But when you need a simpler model that costs a fraction of the cost, we'll do that too.
All right, Eric, great to have you here.
Thanks so much for having me.
Eric Glyman there. He is the co-founder and now co-CEO over at Ramp. When we come back, we're going to talk about Target. The share is up about 5% on the back of the retailer's latest earnings. Some evidence here that that long-time sales slump, well, maybe Michael Fidelki has finally put it behind them. This is The Close on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. And we start off today with Corsair Gaming, the maker of PCs and gear for computer gamers. Goldman Sachs downgrading to sell, calling the company and its counterpart, Cricket, software for hobbyists that are facing a large magnitude of near-term headwinds from elevated PC costs and pressure on consumer discretionary spend. Those shares sliding for a fourth straight day. Next up, Klarna, JPMorgan downgrading to neutral, citing investor sentiment hurdles after the company's guidance cut and that surprise departure over in the C-suite. The firm says obstacles around operations and sentiment require multiple quarters of clean execution to stave off investor fears. Those shares, which fell 23% yesterday, declining further today. And finally, Dollar Tree. Jefferies upgrading today as a two-hold as traffic trends improve. The firm also taking its price target to 135 from 85, with Jefferies saying it doesn't expect further notable share loss. The shares not losing anything today. In fact, they're up for a third straight day to their highest level since February. And that does bring us to Target, another behemoth in the retail space. Those shares having their best day since at least March. The big box retailer reporting earnings this morning, boosting its sales outlook as the comeback begins to take hold. Michael Baker is managing director and senior research analyst over at D.A. Davidson. He's got a buy rating and a $170 price target. Put this quarter up against the last couple of quarters. Michael, is this a turnaround? Is it truly taking hold?
Sure, yeah. Now it's been 2 quarters in a row of same-store sales in the low to mid single-digit range, better margins. It's clear that since Michael Fidelki took over in early February, they've gotten some strength back in terms of merchandising prowess and assortment, and really leaning into what Target was always known for, and that style, creativity, value, really delighting and exciting the customer. And we think we're seeing that in each of the last 2 quarters.
When we talk about the merchandise mix, which of course which has been talked about a lot, the idea that at least for some time, the perception was they didn't have enough consumer staples, groceries and the like that sort of had been a hallmark for Walmart. Are you comfortable with the merchandise mix between the discretionary items and the more necessities, if you will?
Sure, yeah. Target will always lean into the more discretionary part of the mix, and that's what they're known for. They're never going to beat Walmart on grocery. They have been investing in food, though, and really transforming their mix within food to add some more higher-end snacks and interesting type things like that. But really, Target, it's a different shopping trip. It's a different customer. It's much more about discretionary sales. And they sort of lost their way in that a little bit. The merchandising just wasn't as sharp, as fun, as cool as it once was. Michael Fidelki has really focused the team back on that. One example, it might sound silly, but they've renamed their hardline business to Fun 101. And that sort of says it all right there. They're really leaning into what made Target different in the past and maybe lost their way. And again, you're seeing it in each of the last 2 quarters, and we think there's room to go in that. They're never going to become a grocery store. That's not what they're all about. Leave that to somebody else.
That Fun 101 caught my eye as well, and it's up around 11%. So I want to go to traffic, which also rose 3.6%. Is Target finally winning customers back, or are you still seeing cautious customers, especially with inflation increasing?
Yeah, clearly the traffic's up. That tells us they are winning back customers, and we think we're seeing it again, really in a lot of discretionary type areas. I thought a great example of that is Legos, up 30%. Legos is a mature category or a mature product, but they're seeing great growth there because they're adding to what customers want. Yeah, we do think they are winning back customers. You know, the consumer question everyone's asking is how is the consumer, and we saw that retail sales number last week, but I think it wasn't as bad as it looked in terms of the retail sales on Friday. We look at it, the way it was reported is on a seasonally adjusted sequential change, and on that basis it was down and it did miss. But when you look at it non-seasonally adjusted on a year-over-year basis, because that's of course the way retailers look at it, they don't measure their comps on a seasonally adjusted basis. When you look at it non-seasonally adjusted year-over-year, July was actually a really good month, again, for retail sales, and we've seen strength all year. So the consumer, when you give them what they want, they are out there spending.
In around 30 seconds here, you're guiding to 5% sales growth for the year. What would have to go right for Target to materially beat that outlook?
Well, they grew 6% in the first half. So when we think that 5% for the full year, which embeds a 4% in the second half, is prudent. We think it makes sense to be prudent here. There's still a lot to go, but I think the way they'll beat that is by continuing to revamp the merchandise in areas that they haven't touched yet. They've done a lot of changes, and those will continue in the back half, but there's still a lot of areas that they haven't touched. Keep doing that, keep improving the merchandise, and we think they can beat on the top line.
Hey, Michael, always appreciate it. Michael Baker there, Managing Director, Senior Research Analyst over at D.A. Davidson. A closer look at those shares of Target, up more than 5% on the day on the back of those earnings. We also keep an eye on the broader markets. Isabel, the S&P up about 0.3% here. The gain's relatively modest, but of course, all the talk right now is about what we're seeing in the Treasury space and whether this drop that we're seeing in yields, long-term yields, actually holds beyond today.
Sam Stovall just released a note saying there's a saying that the bond market is supposed to be quiet, and it's a big deal when it's not. And now it's definitely not quiet, Romain.
Yeah, that might be the understatement of the day. When we come back, well, we're going to actually go back to the retail space. Beauty products. The CEO of Estée Lauder is going to be joining us in just a second, right here on The Close on Bloomberg. 3:30 p.m. here in New York. This is the countdown to The Close. Romain Bostic alongside Isabel Lee. And taking a closer look, one of the biggest moving stocks of the day is actually Estée Lauder. This after the company's most recent earnings report, a turnaround at the owner of brands like Clinique, La Mer, Jo Malone, gaining momentum under CEO Stéphane de la Faverie. He joins us now here in Studio 2. Great to have you here, Stéphane.
Thank you for having me.
It's a great quarter. You took over almost 2 years ago at the start of 2025, and there were a lot of questions as to exactly how you get this company back onto a path of organic revenue growth. 4 straight quarters of organic growth with regards to net sales, more than 6% in the most recent quarter, and your guidance for the next fiscal year, the full fiscal year, is 3 to 5%. You have confidence that you're going to meet that?
Yeah, absolutely. And I think, like you said, when we announced our new strategy called Beauty Reimagined 18 months ago, we made a set of promises. And today, I'm happy to report that promise made, promise kept. We are reigniting growth, accelerating our innovation, significantly expanding margin, and really investing also in consumer acquisition and behind our brand. So we are, as you said, having great momentum into fiscal 26. We have had 4 consecutive quarters of growth. The strongest quarter was the last one at over 5% growth. So that gives us good momentum. We have the playbook, we have the right brand, we have obviously the right team, and we are ready to accelerate in fiscal 27.
There are some concerns, despite the big move that we saw in the share price today, still some concerns about investors about some momentum going forward. And when I look at the guidance for the full year, that 3 to 5%, I mean, if you hit the low end of that range, that's not really an acceleration in growth. I'm sure you're aware of that.
Absolutely.
Here. The question you always have to ask CEOs, are you sort of lowballing this so that you can kind of manage expectations and beat that?
So look, in fiscal 26, we had guided 0 to 3, and we hit the top end of the guidance. So our objective, as we see the beauty market, and especially the prestige beauty market, accelerating around the world, we want to just take the opportunity of the market accelerating and us accelerating. We have a slate of new innovation coming to market. My ambition with the team is always to work minimum to deliver the middle of the guidance, if not more, obviously, if we can. And we're putting our brand ready in the right channel where the consumers are to obviously accelerate in fiscal 27.
Well, let's talk about those channels. You've done partnerships with TikTok and Amazon, a bit of a departure for Estée Lauder in the past. You've cut a lot of jobs, primarily in that sort of, one-on-one distribution side of it. Is this the future of Estée Lauder distribution?
So I think it's just we are adapting our distribution, obviously, as the consumers are also evolving, and our job is also to meet the consumers where they are. That is in China, in the US, in Europe, wherever they are around the world. So our idea was just to rebalance, and that's the first pillar of Beauty Reimagined, is to accelerate the distribution expansion where the growth is and where the consumers are. But we always do it by protecting quality and experience that we are bringing with our consumers. So today we are feeling that we are in a good place where from social commerce to specialty multi to our own direct to consumers, and obviously the department stores, we have actually the right distribution channel that allows us to capture both on the recruitment front, but also on the retention front, all the consumers throughout the spectrum.
Well, with regards to some of those partnerships, I am curious, do you get the same margin, or are you sort of having to sacrifice a little bit of margin in some of those partnerships as opposed to the normal retail?
Well, I think what we are always looking at, we want not only the distribution to be margin accretive for us, but also to be equity driven for our brand. The decision that we always took is first and foremost, are we going to build desirability and equity with the brand that we have today? And today, what we've done, you mentioned Amazon, TikTok Shop, we have Douyin in China, and many other brands. Every single time we are working with our partners to continue to develop the experience and enhance the equity and the desirability of our brand. And I follow very closely with my team. The desirability ranking is one thing, market share is another thing, but brand desirability, brand equity is always the first KPI we look. So whatever move we do from a distribution to new innovation to campaign, the key indicators is always to create more brand love with the consumer to keep them for a long time.
Let's talk about the skincare business. The previous quarter, Q3, fiscal Q3, that was flat.
Yes.
That rebounded nicely in Q4. What changed?
Innovation, the innovation pipeline, and I mentioned it in quarter three. We had a softer innovation pipeline in Q3, and we ramped it up, and we finished in a very strong high note at plus 4% in skincare for quarter four. And I mentioned it this morning, during the call, we have a slate of new innovations, starting with Estée Lauder, with Clinique The Ordinary, that have been going from strength to strength, around the world. And the good news is that we have innovation at various price points. At the entry price point with The Ordinary, with Estée Lauder in the middle of prestige, and obviously La Mer that is going after the luxury consumer. So sometimes you may have some adjustment, and that's why I always look at the full 12 months of innovation, and we've guided next year a 200 to 250 basis point improvement on innovation led by skincare. So you may always have some quarter that are softer than others, but when you look at it on a 12 months rolling, we feel very good about the innovation pipeline coming in the next fiscal year.
How much of that innovation pipeline might actually apply to the hair care business, which was down in the most recent quarter? I was kind of surprised by that. Is that just some sort of cyclical trend, or something secular, or something you're doing?
No, I think for hair care, we had to reposition our brand in the right channel. And we see today, especially for a brand like Aveda, we're seeing great momentum in North America, being the largest geography for Aveda, where we're seeing with the move that we've done with Amazon, with TikTok Shop, but also repositioning the brand in the salon network, in the track data salon network, we're seeing improvement in our performance. But to answer your question more directly, innovation is also on hair care. We have innovation on skincare, on makeup, on fragrances, and hair care. Part of the beauty reimagined strategy is the diversification of our growth. Diversification doesn't come only from channel, it also comes from category for brands, but also from the type of innovation that we're bringing to market. So you're going to see also more coming in hair care going forward.
Your fragrance business, no surprise, was the strongest, at least on a growth basis. Should we think of Estée Lauder more as a fragrance company going forward, or is your goal to have everything kind of balanced out between skin, hair care, et cetera?
Again, diversification of growth. I think in this moment in time, fragrances is one of the categories that is the fastest growing in beauty. We happen to have a very strong portfolio of luxury brands from Tom Ford to Jo Malone, Le Labo, Kilian, that are within our fastest growing brand in the company. Now what we're doing in fiscal 27 is not only accelerating what we've done with luxury fragrances, but also entering in a much more meaningful way in prestige fragrances, which is the bulk of the market. We've started in fiscal 26 with Balmain Beauty, that has been off to a very strong start in markets like the US, the UK, and continental Europe. And now, for the first time in over a decade, we have a really strong launch with the Estée Lauder brand called Glyman is actually in store. And also Kilian is launching a new prestige line. So it allows us to really continue the strong momentum that we have had in fiscal 26 into 27. And we have had one of the best performing in the market. And
I wanted to ask you about Glimmer. That's Haley Steinfeld's brand. So is the strategy to kind of build things up within kind of the Estée Lauder system, or to buy? And I asked that in the context, too, because there was a lot of talk about the potential tie-up with Pooch, which went under for a wide variety of reasons. Were you in favor of that deal?
Yeah, but I was basically supporting it. Look, our philosophy on M&A is very simple. First of all, we always look at our organic growth internally, and that's why we are accelerating the diversification that we're having within our own brand. But when we look at M&A, we look at three things. First, is it a good brand? Is there something in front of us that is going to be complementary to the portfolio? Think about our portfolio of fragrances, from Jo Malone to Tom Ford to Le Labo, Kilian, Frédéric Malle. They're all very different. They tailor to different consumers. They have different distribution, different price point, different business model. So we make sure it's complementary. The second thing, is it going to allow us to diversify growth somewhere from a geography, from a channel? But more importantly, at the end of the day, is it at the right price point?
Yeah.
And that's always the right thing that we're doing to see, is it going to
So you walked away from that because of price?
Correct.
It was price, okay. I am curious though, the CFO said on the conference call today, talked about deleveraging, talked about CapEx, dividend, no buyback mentioned, but I was also curious about M&A, and there was no explicit talk of that, but I am curious if you do plan to pursue other M&A deals, assuming the price is right, as you say?
Yeah, we will always be part of the M&A conversation. I've been very clear.
Large ones, or are these just kind of...
Look, at the end of it, it means to be complementary, but I think one that we've announced recently is for us Essential, the leading prestige brand in India. And for us, I've been very clear that I want to accelerate the penetration of emerging market. We see a great potential. And after the wave of K-beauty that we're seeing around the world, we see Indian beauty getting a great potential. So for us, Essential is the next acquisition. We are waiting for regulatory approval to launch the brand within our portfolio. But that's the type of acquisition that we are looking at.
Well, let's talk about some of the share that you're making in Asia, Japan, Korea. China business had 6 straight quarters now, I think, of share gains there. You're relatively well diversified geographically. And I am curious, though, do you see more opportunity from Asia to expand the business where it becomes a larger share of total sales?
Yeah, I think what I'm very excited is actually to see the recovery of China. China as a market is very strong, and we're seeing accelerated in the high single digit. And the good news, like you said, 6 quarters in a row, we've been able to gain market share. So in a very dynamic market, we're seeing acceleration. We're seeing also market share gain in Japan. Korea is actually, as a market, is really also coming back after a few years of softness. Not only the market is stronger, but we're also strong. So we are seeing great potential. In Asia, they love beauty, and we are always part of it.
But kind of square that, but you've talked about this idea that China has kind of moved away from just being a growth market to a more mature market. How do you fit in? I know you have a big R&D center there in Shanghai, the idea of creating things for the Chinese within China. Absolutely. That's the strategy.
Absolutely. Yeah. Today, we have 30% of our innovation globally that is coming from our R&D center in China. And the strategy originally was always to create an R&D center that was creating innovation in China for China. Because the Chinese consumers have different habits. They have different regimen. Their skin regimen is very different. So we're developing a lot more product that is allowing us to be not only more locally relevant, but also to be more into culture in China. And this product are really helping us to support the growth that we're seeing in China and frankly across Asia.
A couple more questions here. Travel retail. I mean, a few years ago, this almost basically destroyed Estée Lauder. And it's come back based on the most recent quarters. Is that going to be a sustainable sort of pocket of growth for you?
Yeah, I see travel retail. Today we are at the right level. I've said it very clearly. We have about 15% of our business that is coming from travel retail, which is a much lower percentage of the business than we used to be, which allows us also to just navigate volatility in a much better way. But today, travel retail is still a window to the world when it comes to discovering our brands, and we're seeing a lot of great potential. Hainan, we're growing double digit, but we're seing Korea, Hong Kong, Thailand also growing. Obviously, Europe has been slightly disrupted in this fiscal year because of the conflict in the Middle East, but we're even seeing for us America doing very well. So I see travel retail as a growth potential for us, but more in line with industry standards, which is about 15% of our business going forward.
Well, speaking of the Middle East, I mean, can you quantify how much the conflict over there is costing you business?
Yeah, for us, when you put the Middle East, Israel, and travel retail, it's about less than 2% of our business. So it has been very manageable for us to navigate it. It's also one of the reasons this morning where we called out that while we're going to have stronger growth in the first half versus the second half due to the innovation pipeline, it's not correct also in our emerging market because we expect a rebound in the Middle East that will allow us to just have a stronger second half.
I do have to ask you, you're a Frenchman running probably the biggest, if not the most well-known U.S.-grown beauty products company out there. What does that say about why you're there and what Estée Lauder is looking for.
Maybe just like a little bit of a clin d'oeil. I was born in the U.S. despite my French accent, so I have like the dual citizenship. But I feel very humble and very proud. Like on the 80th anniversary of the Estée Lauder company, to manage what I believe is one of the most beautiful portfolio of brand in the world, and certainly an amazing team that is delivering outstanding results in 26. And I have no doubt that we will continue in 27 and beyond.
And part of that history, you're going to keep up the relationship with Saks. You go back to the early days, and
always. This is part of like what we do. Our history is very important, and we are working with our historical partner to continue to reinvent experience in the store. At the end of the day, Estée was the first one who created this notion of eye touch in the US and creating beauty as we know it in so many ways. And we'll continue to do it, but we'll use new channels, new media to be able to just connect with consumers and delight them wherever they are.
And just to be clear, your relationship with this sort of new Saks, which is out of bankruptcy now, it's good. You're providing product to them.
Absolutely. We have resumed shipping, and we're very happy with the partnership that we have with Saks.
Well, Stéphane, really appreciate you being here.
Thank you so much.
Appreciate it so
Thank you for having me.
Thank you so much. Stéphane de la Faverie, the president and CEO of the Estée Lauder companies. Isabel?
Romain, that was a fantastic conversation. Again, Estée Lauder results beat estimates, ending a run of 3 straight declines in annual revenue. Again, thank you for that conversation. Let's shift gears a little bit because we have a big mover here. Our stock of the hour is Moderna. Shares more than doubling after a major win in its melanoma study. Joining us live is Bloomberg's Madison Muller, who covers everything in the space. So is this a breakthrough that finally proves mRNA's success beyond COVID, or is it too early to tell?
I think that that's what we're seeing in the share reaction today, is that investors are really excited about this, and they do see this as a breakthrough for mRNA technology beyond the COVID-19 vaccines that we all know it so well for. The technology has been successful in other infectious diseases, but in terms of a business opportunity, I mean, this is something that is potentially really transformative, potentially really big, and brings Moderna into a new area beyond infectious diseases, into potentially oncology, and that is a pretty transformative moment, I think, for the company and for science.
So give us a sense here, kind of what sets. This is a late stage trial. We still need, obviously, the FDA to kind of put a check mark next to this at some point. What's the time frame?
Yeah, exactly. So we will still need, the company said that they are discussing right now with regulators some of this data. They are going to unveil more data at some point later this year. And then they'll file for approval. That'll get FDA review. And the companies have said that they sort of expect probably to get some type of decision by next year, so 2027.
So how big could this really become for Merck and for Moderna if melanoma is only a starting point?
Exactly. So the companies are testing this technology in other types of tumors, in bladder cancer, in lung cancer, and that's really where the opportunity lies. I mean, melanoma is the most serious form of skin cancer. It's a really deadly form of cancer. But there are other opportunities, and that is what, at least in terms of what Bloomberg Intelligence thinks, that's really where the financial opportunity will be for these companies, is expanding into other types of cancer.
Well, let's talk about the financial cost of this. My understanding, this is going to be, if it does come to market, a pretty expensive drug. What is sort of the cost benefit relative to more traditional treatments that you would have for melanoma or other cancer should it progress?
Yeah, exactly. Because this is a personalized vaccine, the assumption, and we don't know any information about pricing yet, but a lot of cancer treatments can be quite expensive anyway. So the thought is that this will probably be a more expensive treatment option. This is also something that's added on to Keytruda. So Keytruda is Merck's blockbuster cancer drug, and this vaccine's taken in combination with Keytruda to prevent cancer from sort of coming back or advancing. And so you treat the cancer with Keytruda, and then you add this vaccine on, sort of training the body's immune system to learn how to fight these cancer cells, prevent it from coming back. So right now, what we're waiting for is additional data about how this vaccine sort of fares in terms of like actually extending survival. We know that this trial was successful. We don't know the magnitude of how successful it was in terms of how long we're actually extending life. So that's sort of the next data that we're waiting for. That will be important for insurance companies and for payers when they're thinking about reimbursing this and whether or not to cover it.
All right, well, a glimmer of hope for some of those patients out there, and obviously more than a glimmer of hope for investors who had been looking for a turnaround in this stock. Madison Muller there, Moderna share is now up 171%. Needless to say, that is the best day on record as a public company. Meanwhile, moving in the opposite direction is SpaceX, down about 3%. The shares were already lower, but we just learned a little while ago that the firm actually approached the coding startup Cognition AI about a potential acquisition. Ed Ludlow joins us right now to talk a little bit more about this. Ed, why is this important? What was Elon Musk fishing around for here?
Yeah, it's important because Cognition's one of the hottest properties in agentic AI and AI coding right now. We recently reported it was valued, or in talks to be valued, at about $40 billion. So at some point in the last couple of months, SpaceX AI approached Cognition and made an offer, a proposal to acquire them. And my understanding is Cognition rebuffed them, said no. There isn't a price that Cognition was willing to sell itself at. But it's just recognition for SpaceX and Elon Musk that the growth in the future is AI. And, Cognition's coding tool, or agent Devin, has become successful, quite pervasive in the ecosystem. And it's a very interesting story. I think the added detail is that our understanding is they're continuing to talk, but about technology. SpaceX AI has the business of renting out compute capacity. Devin is a useful AI coding agent, and those kind of technology talks continue outside of the M&A context.
Ed, this is a fantastic scoop from you and the team. Talk to us about Elon Musk's willingness to spend heavily on AI. I mean, they just recently acquired Cursor as well, which is a fast-growing startup.
Yeah, so, the chronology is interesting. Our understanding, right, is that there are no active M&A talks right now between SpaceX and Cognition, but they just closed the Cursor deal, a $60 billion deal. Our latest reporting is that Cognition is in talks to raise money at a $40 billion valuation. It also raised the question of those companies are very similar, right? They are both coding platforms. Cursor is basically an AI-powered coding tool that can rewrite code, whereas I suppose the distinction with Cognition's Devin is that it's a more fully autonomous agent. The point that sources make to me is that Cognition's moved very fast to actually sell its products in the real world. They have this army of forward-deployed engineers that have allowed them to get into pretty run-of-the-mill standard Fortune 500 companies that use Devin. And to Elon Musk and SpaceX, that's attractive because they've not had as much traction with the enterprise customer. Maybe they saw Cognition as a way into that, different from the pure play technology acquisition of Cursor.
Thank you, Ed. That was a great exclusive for you and the team. That's Bloomberg's Ed Ludlow. Let's take a look at now where markets stand as we get ready to close out the day. Romain, the bond market still remains the big story of the day, and I feel like we haven't talked about the Fed just yet.
Yeah, and it really is the only story of the day. Apologies to everyone else, but we talk about what was clearly a surprise move by Scott Bessent. Probably shouldn't have been a surprise given the last buyback, but more importantly, the idea that he has made it clear, if not necessarily explicitly in his words, certainly in some of his actions, that he was there to defend Treasury yields, to keep some sort of cap on them. The question is, what does this do? You go from $2 billion to $4 billion. You sort of characterize it as being about liquidity. A lot of people are looking through this and saying, look, the issues that plague the Treasury market right now, to a certain extent, are out of his control.
Absolutely.
I mean, this is a fiscal issue, and if he really wants to address it, maybe he should, hop in an Uber down to Capitol Hill and talk to the clowns down there.
And you made a great point earlier in the show that this is just really a Band-Aid solution. At the end of the day, it's just really a reminder that the Treasury Department is paying attention, and maybe we'll do whatever it takes to keep yields from getting too high too quickly, maybe. Yeah, and we saw the Fed minutes showing the concern still persistent about inflation, so that's something else that Bessent, and more importantly, the Fed will have to deal with, and the market will have to contend with as well. Eli Salzmann joins us right now to help count us down to the closing bell. He's a senior portfolio manager over at Neuberger. And Eli, that is where I want to start here with the sort of the rate story. And obviously, nothing here is extreme on the surface, but obviously there has been some talk for years, really. First from a lot of the Pollyannas about the fiscal situation and its effect on treasuries. But now we're starting to realize some of those Pollyannas, maybe they weren't so crazy after all. If you're an equity investor, do you worry about this now or just wait till the shoe drops?
Yeah, I mean, first of all, very good to see you. Secondly, the amount of fiscal, the number of fiscal issues, as well as the amount of fiscal stimulus that's been pumped in addition to the monetary stimulus, what Bessent did today, you guys summed it up, it's a Band-Aid. It's a nothing burger. And the reality is yields will go with the fiscal situation, and they will also go with the economy and as well as inflation. And with the amount of fiscal and monetary stimulus that's out there, and with the economy doing as well as it is, and the lack of excess capacity and the higher inflation, yields are still going up. This is a one-day move. Maybe it's a two-day move, but inevitably, we think yields are going up from here.
Well, what does that actually mean for equities? And I'm pretty much talking about some of the long duration equities that have sort of led this bull market rally. Does that knock them down a peg, or can they sort of navigate through whatever the next leg up in yields might be?
Yeah, listen, short duration is value, long duration is growth. We're obviously very bullish on value over growth here. And, we think the long duration stocks get hit here. As yields go, as the 10-year goes to 5 or even higher than 5, which we think it's going to, no question about it, long duration stocks get hit, which mean value over growth. People don't realize, but, value's ahead of growth this year by over 20%. We think it's going a lot further.
What about minutes? It shows earlier that several officials wanted a hike. Do you think that the market is still underestimating the risk of rate increases for this year?
Yeah, I think they are. I don't expect the rate increase to be till after midterms, but we're expecting that, call it over the next 6 months. And again, I'm speaking on behalf of myself and the large cap value group. We're expecting rates to be up probably about 100 basis points over the next 6 months. So we're looking for Warsh to tighten pretty dramatically at the end of this year or early next year.
So if rates stay higher for longer, why shouldn't investors simply keep paying up for mega cap large tech stocks?
Well, because long duration stocks, those mega cap stocks, those so-called long duration growth stocks are clearly going to get hit here, because as the 10-year goes up, it's going to cause multiple compression. You've already seen some, you're about to see a lot more.
So let's talk a little bit and broaden this out too, because when we talk about an earnings season that we're almost through, it's been a phenomenal earnings season, but a lot of people are wondering whether we've kind of reached the peak. My question for you is more on the value side and the broadening of this earnings growth, which has gone from just, the big hyperscalers and the NVIDIAs and chip makers to now a lot of other people sort of participating in that growth story. Is that sustainable?
Yeah, no, we think the broadening is there. It's all about LEIs, leading economic indicators. And as long as LEIs are accelerating and moving upward here, you're going to get a broadening out of the market. So we expect LEIs not to peak until roughly this time next year. It might be a tad earlier, but through the end of this year, if that's your question, LEIs are going to head up. The broadening should occur, and value, we would expect, would expand its lead relative to growth.
So and we've seen that show up in some of the factors that we track on the Bloomberg terminal. Any concerns about seasonality, particularly given that there are a lot of folks that have said, look, not only are we at peak earnings, but we might be at some peak valuations, not necessarily long term, but certainly in the short term. And if some folks have sort of made pretty healthy profits through the first 6 to 8 months of the year, how much activity can we really expect in the last, say, 3 months?
Yeah, it's a really good question. August and September are typically rough times for the market, especially September. You look back, in history, September is never a great time for the market. We can't worry about that short term. We think that over the next 6 to 9 months, not only is the market going higher, and again, we're not calling the market, but we think value is going higher.
I want to go back to the Fed. Warsh is considering cutting the number of Fed meetings from 8 to 6. Does that make the Fed more thoughtful or less responsive? And how do you respond to that as a portfolio manager?
Obviously we're always curious what the Fed has to say, but we're looking at the economic data. So, the reality is when we look out, we're thinking horizontally about, again, the amount of stimulus that's out there. What Warsh does in a meeting or not in a meeting, that's one thing, but it's more important about the economy in the end is what drives everything. And the higher economy, the higher inflation due to the lack of excess capacity that's out there right now, we're very concerned. And again, with that concern comes value over growth. Concerned about, back to your question about long duration stocks, we think long duration stocks are going to take it on the chin here. Long duration are the growth stocks.
Hey, Eli, great to catch up with you. Eli Salzmann there, Senior Portfolio Manager over at Neuberger, counting us down to the closing bells with the S&P 500, Isabel, just holding on to fractional gains on the day, getting a big bump from Apple and Amazon, but the NASDAQ 100 now poised for a 4th straight day of losses, largely because of that big decline in NVIDIA.
It's really those chip makers dropping once again. We're seeing more gainers in the S&P, but the mega cap tech stocks are the ones dragging them down. Absolutely. Broadcom, NVIDIA, AMD, all in the red to the upside. We've talked a lot about Moderna, Estée, Lauder, and Merck, also getting a boost from Coinbase and Carvana. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Isabel Lee, taking you through to that closing bell. It's a global simulcast. Carol Massar joins us from the radio booth. Emily Grafeo in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube, the S&P 500. Trying to recoup some of the losses from the previous 3 sessions, but only up right now about 15 points or 0.2%.
Yeah, I feel like it didn't get much from those Fed minutes, right? That's how we kicked off our 2 o'clock hour here on Bloomberg Business Week Daily. And those minutes, though, did show that many officials said rate hikes may be needed. But it sounds like, Emily, there's a little bit of debate going on there.
Yeah, there's a debate. And at least for the 2-year yield, it's not really making moves right now. But a lot of focus today on that flattening, relative flattening in the yield curve and the longer end yields moving lower.
I was just telling Romaine that Sam Stovall said that the bond market is supposed to be quiet, and when it's not, that's a big deal, and it's definitely not. It's certainly been making noise. Long-term yields are climbing across the U.S. and other developed markets, France, Germany, and what else? There's one country I'm forgetting, but definitely a global movement.
Yeah, and it kind of sets up kind of this idea, and we've been talking about it a lot on the close and on this simulcast, just the outsized importance that some of these macro and economic issues are going to start to have on the market relative to what we saw in the first few months of this year, where it really was just about, hey, just look at the AI CapEx spend and follow that and ride that wave. That might be changing.
Yeah, absolutely. I do feel like that narrative around AI in total continues to evolve, and you see it also play out in the trade domain.
All right, so a big drop in long-term yields here on this Wednesday afternoon. That's putting pressure on the dollar, which is down about almost 1% on the day as measured by the Bloomberg Dollar Spot Index. And, well, for everything else, though, it's providing a nice little bit of a boost. Most of the equities in the S&P 500 are in the green, and so the S&P 500 finishes in the green, right around 7708 and change, up 17 points or 0.2%. The Dow up more than 100 points or 0.2%. The Nasdaq Composite is up 0.2%, though the Nasdaq 100 is down by 0.2%, and the Russell 2000 getting in on the action. That's actually your relative outperformer, up by 0.5 percentage point.
Yeah, kind of interesting to see that. I'm going to go back, though, to the large caps, if I may, the S&P 500. You mentioned it, Romaine. If I look inside the index, almost an even split is about 285 names gaining ground on this Wednesday, 216 to the downside, 2 unchanged.
It may look like an even split, but tech is our biggest loser. You see a big red there, tech down by nearly 2% or even more than 2%. And you're seeing also communication services and financials in the red. Some of the bright spots, consumer staples, energy, materials, all higher by something like 0.2 to 0.3%.
All right, guys, let's get to some of the individual gainers, if I may. Let's bring up Moderna, because this one is definitely an outperformer, top gainer. In fact, that we saw in the S&P 500 today, that name up 30%. It's up about 375% year to date. 13% of the float is short. I got to check that's the year to date, but I'll do that in a moment. The stock's biggest intraday gain.
You didn't check this in advance?
I did. I just, I have to tell you, no, it's in my notes. And then looking at it, I'm like, I just don't even believe it. It's actually up 491% year to date. So there you go. Definitely outperformance. You've got 13% of the float short. This is happening after the biotech company said a personalized cancer vaccine combined with partner Merck's Keytruda helped cut the recurrence of melanoma in a large late-stage trial. So this study provided the strongest evidence yet that messenger RNA technology will have a successful second act, and the companies will discuss filing for approval with regulators and present the data at an upcoming medical meeting. So this provides certainly some tailwinds for this company that's certainly had its ups and downs. Estée Lauder, speaking of ups and downs, let's get to that one. This was a top gainer, too, among the S&P 500. Number 2 gainer. The stock, actually, we're going to bring up Estée Lauder. I don't know if we've got it. That was Moderna. So let me bring up Estée Lauder on my terminal. And Estée Lauder.
What do you guys do without me? So Estée Lauder shares up 16%, Carol Massar. Best day since November of 2011. And I should point out, I just had an interview with the CEO of Estée Lauder, how he keeps the momentum going.
Would you like to do the rest of the list?
No.
Okay. Thank you very much. All right. Well, shares jumping after the results beat estimates and ended a run of 3 straight declines in annual revenue. Company reported revenue of $3.6 billion in its fiscal fourth quarter, and organic sales growth accelerated to 5%. China was an element, but this is a company that owns many, many brands and has really struggled. Keep in mind the stock is down, or at least it was down about 74% from a high back in early January of 2022. So still has some room to gain back. I want to mention too Twist Bioscience and also the life science and tools area. Twist Bioscience, you can see up 22% in today's session. This company rose to its highest, in more than 5 years after Anthropic chose the drug developer as one of its independent evaluators to help produce AI-designed proteins at scale and test these designs for binding. So it's interesting. It has to do with DNA. So just kind of an interesting trade. Didn't mean to be sharp with you, Romain. I was just,
That's all right. It's my first day back. But
I know. You obviously have had a rest. I should also mention Hyperliquid, I think, was also a lot higher. Yeah, forgive me. That was my bad. You did put that up first. It was up 30% in today's session. And this happened after President Trump said in that meeting with crypto execs that the CFTC chair is working to bring Hyperliquid to the U.S. And our own Stacey Marie Ishmael said that that was a pretty interesting development. So again, yeah, and this one has been an outperformer this year. All right, all yours.
All right, let's head to the decliners. I'm starting with TJX, of course. This is the parent company of TJ Maxx Home Goods. It fell today. It was down about 4%. The clothing retailer reported second quarter comp sales for its Marmaxx segment, which missed estimates. So the Marmaxx segment is the parent of TJ Maxx and Marshalls, the names we know well. Actually, the top line comp sales did beat, and the Home Goods comp sales also beat estimates. A lot of people going out buying little figurines of mugs or frames, whatever you can get at Home Goods, but nevertheless, the stock.
What are you talking about? Have you ever been in Home Goods, Emily? It's more than just figurines.
Oh my God!
You get like mirrors. You can get like.
Oh my God!
How dare you?
Cajun pistachios.
Should we tell
soap.
her? Yeah, no. We have to take you to a TJ Maxx. To a
no.
Home Goods. There's so much that there's furniture.
No, there's a lot there, but it's a lot of. There is this like running joke on TikTok about
dishes.
like very hyper specific things that you can only find at Home Goods. I won't.
Where
get into
else
it
am
right
I going to
now.
get my Live, Laugh, Love
Exactly.
wood panel?
Wood panel with a Santa on the side holding it up.
Family means everything. All those good
Okay, so TJX Group lower. Viking Holdings was another decliner. The shares down about 8%. Management of the river cruise company trying to soothe investor concerns today about the impact of low water levels in the Danube and Rhine rivers. This is an issue that's prompted the cruise line operator to issue vouchers to some travelers. So shareholders not too happy about that kind of update. The company, though, did say that about 53% of its capacity for 2027 has been booked, while increasing its offerings across river and ocean products by 15%. So this is a luxury consumer, signaling at least some resilient demand for the luxury side, whereas you think of a TJ Maxx Group. I mean, I feel like that's kind of for everyone, but definitely known to be more on the lower income side. Definitely not a luxury product, but both reads from the consumer here, maybe not looking too hot, at least at today's trade. Okay, and then finally, White Fiber. This is a smaller cap name. It's about just $1 billion in market cap, but it did fall about 21% today. They priced a private placement, $270 million of a senior note offering to build out AI infrastructure. So this just stood out to me because, again, we're seeing AI companies of all different shapes and sizes tapping the debt markets. Eventually, you have to see maybe some questions from the equity shareholders about just what all of this is needed for.
Well, speaking of debt markets, we have to talk about the Treasury markets, the big drop that we saw on the long end of the curve, down 11 basis points, on your 20-year yield, 10 basis points on your 30-year yield, the biggest one-day drop that we've seen in yields on the long bonds since late June. Obviously, all of this tied to Scott Bessent lifting the Treasury's buyback cap, doubling it, I should say, from $2 billion to $4 billion. Liquidity measures, as he puts it, but obviously a lot of questions right now about just what type of mechanisms the Fed is using to sort of keep a cap on yields, and more importantly, why.
Yeah, so let's get to some stories that are definitely on our radar. This one caught our attention. Actually, our Alexis Christoforous talked about it on Surveillance this morning. We know the pushback on a lot of the AI data center build. Well, Liquid Death and Garage Beer have launched a campaign called We Want Your Pee. to help AI data centers cool down without using large amounts of water. So it features a video spot with Garage Beer co-owner Jason Kelsey, you know him well, collecting his urine in a bottle and singing a song about sending pee to data centers. Before you get upset and you're like, oh my God, what has happened in this world? Keep in mind, it's a joke, everybody. But they just
obviously, I would hope so.
we live in an interesting
yeah.
time, Romaine. So
So we're giving them a lot of
make the
attention.
assumption.
For our radio viewers, they're walking through a meadow right now with a farmer and a skateboarder for some reason, all holding up large bottles of their own liquids.
But it's got a straw. One of them had a tumbler with a straw.
Yeah, there's a guy with a briefcase, some guy on a mobility scooter. I don't know how you get that through a meadow.
Well, I should point out this story by Adweek also just points out that about 7 out of 10 Americans oppose data centers being built in their community. So it's kind of having some fun with this, just reminding everybody of the impact.
I never thought I'd talk about this as a markets reporter, but there's the first time for everything.
We talk about everything here at
Yeah.
Bloomberg. No doubt about it. All right, guys, that is a wrap. Welcome back, Romaine. We did kind of miss you. Our cross-platform radio, TV, YouTube, Bloomberg Originals, we do call it the closing bell. Isabel and Romaine, they're on the close on Bloomberg Television, and Emily and I back here on Bloomberg Business Week Daily. We will see you again, same time, same place tomorrow.
When we come back, our coverage continues here on The Close, a closer look at that big decision by the Treasury with regards to its buybacks and exactly how the market is now starting to price this new Treasury Department in. We're going to catch up with Greg Peters over at PGIM when we come back after the break, right here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Isabel Lee.
And I'm Romaine Bostic. Markets just closed about 12 minutes ago. The S&P trying to shake off the doldrums from the past 3 days. The index only finishing higher by about 0.2% on the day, but that still pins it back above that 7,700 mark. The Philadelphia Semiconductor Index down for a second straight day. And we got to talk about what we're seeing in the yield space and the dollar as well. Your 30-year yield dropping about 10 basis points on the day. We're going to get back to that story in just a second, Isabel. And then you see the dollar also taking a leg down, the biggest drop that we saw for the Bloomberg Dollar Spot Index in about 3 weeks. Remember, it had been on a pretty significant uptrend back in May and June. And then by the time you got to mid to late July, it really started that downtrend, and that accelerated today with that announcement by the Treasury.
And to your point, Romaine, earlier, that the story of the day is really just the bond market. Everything is about the bond market, and this comes just 2 weeks after releasing the planned schedule for buybacks for this quarter. And the Treasury said it's increasing by at least double the size of liquidity support buyback operations. So definitely big news out there, Romaine. So maybe we did get some movers under the hood. We're looking at Carvana. We have shares closing the day in the green after a report showed that Mark Walter's stake in the company was pledged. This means he wouldn't be able to immediately sell them as he contends with a federal probe of his investment empire. Moderna also shares jumping triple digits. That's after the company said a personalized cancer vaccine combined with Merck helped cut the recurrence of melanoma in a late-stage trial. And last, Target shares, or should I say Target, Romaine, they're in the green after the retailer's comparable sales and adjusted EPS for the second quarter beat expectations.
All right, let's turn back to what we were seeing today in the Treasury market, because that is our top story, and it is that fresh attempt to rein in long-term borrowing costs from multi-year highs. Scott Bessent and the U.S. Treasury set to ramp up buybacks starting early next month of long-dated government debt, saying it's increasing by at least double the size. Liquidity measures, as he said, and that's going to focus a lot on the 10 to 30-year sector. The move comes just 2 weeks after the department released its planned schedule for buybacks this quarter, and as long-dated bond yields around the globe rose to significant levels this week. The U.S. 30-year right now still camped out around its highest levels since 2007. Greg Peters joins us right now, co-CIO of Public and Private Fixed Income over at PGIM. Greg, great to see you here.
Okay.
What was your reaction this morning when you heard about this?
Well, I wasn't surprised. What I think that threat was out there for a while. Like, I think market participants knew that this administration would look to doing things that are unconventional, and this was definitely on the table. But I think the real question is, what does it mean for kind of long-term viability? So there's a difference between a trade and an investment, right? So clearly this was a great trade for Bessent today, $200 million cost saving for the taxpayers on the 20-year auction. That's great. But this is a very different mechanism than the Fed, right? Because ultimately that money has to be repatriated back into the system, likely through T-bills. And so the real question is, what does that do to the longer term premium in the Treasury market? And so will it be self-defeating or self-limiting? My sense is it will be. So we'll know more over a longer time frame.
Well, when we talk about that term premium, and more importantly, I mean, let's just talk about kind of why we even ended up with yields this high to begin with. I mean, there are a lot of structural issues right now in this nation that really have nothing to do specifically with what Scott Bessent and the Treasury are doing. It's more kind of what Congress is passing and what the president is signing off on. Obviously, that's not a quick fix. So if you are looking at a 30-year or a 20-year as an investor, then what actually compensates you for that risk, the inflation risk and the fiscal risk?
Yeah, I mean, it's a distraction ultimately, right? And so pay attention to the buybacks over here. And over here, we're not doing anything about the root problem, which is the deficit, right? And so that's why I think it's also somewhat of a limiting strategy. So I understand that the administration is very focused on the level of yields. But at the same time, it's a fundamentally driven market. And over time, those fundamentals start to assert itself. And today is just kind of a cleansing of the short base.
With regards to the yen intervention led by the U.S. A week or so ago, was that about yields? U.S. Treasury yields?
I think so.
Yeah.
What was interesting today was, you saw kind of another move in yen, right, dollar yen, which seems to suggest, there's a yield component, but there's a belief that this Treasury Department is prone to intervention, right? And so you have to kind of watch out for whether it's in FX markets or the rate market. But I believe that basically the intervention on the yen side was more to do with U.S. Treasuries than it was on the level of the currency.
How much can these Treasury buybacks actually achieve if especially deficit, inflation, corporate issuances are pushing yields higher?
I think it's a drop in the ocean ultimately. At the end of the day, you'll see a pickup in issuance, net issuance in the back half of next year and into the following years. Once again, this is a debt and deficit problem and less to do around the kind of the issuance, right? And I think the U.S. has benefited vis-a-vis other jurisdictions because I do think the U.S. Treasury does a much, much better job around their issuance schedule, regular and predictable and alike, and that has kind of helped the U.S. The question here is, by changing those dynamics of the buybacks or regular and predictable, does that have the opposite effect where the back end actually starts to untether and no longer does the U.S. yield curve get the benefit of the doubt? It's an open question. We don't know, but these are the kind of the risks on the table as I see them.
Do you think the markets is going to see right through it?
Over time, I think over time, but look, there was a big short base in the market. All the stories were about the level of yields. The administration is clearly focused on the level of yields. And so maybe it sets a ceiling over the short term, but over the long term, I think it's harder. I think it's about the fundamentals and less about kind of the intervention. And interventions rarely work, right? So there has to be something structural in the shift, and maybe that's on the come, and we just haven't seen it yet.
I am curious. One of our colleagues wrote a great piece today about this idea of maybe the Treasury being crowded out of the bond market because of all of the issuance coming from the AI infrastructure build out, and the idea that you have real competition right now, both in terms of actual yield, buy and hold yield, but even transactional value of some of this AI debt as opposed to some of the longer duration Treasury debt. Is that valid, or is that just kind of,
I think there's a confluence of events. I do believe the crowding out story is a real one. The AI build out is an important piece of it. Keep in mind that it's long duration debt that's hitting the market, right? So that's putting a lot of duration dollars into the space. That does, all else equal, crowd out U.S. Treasuries, particularly given the deal sizes. You have to pay attention to it, right? They're rivaling the size of auctions at this point, right? But then there's other things going on, and I think Japan's another key piece where those yields are higher. And so yields are higher everywhere, and so the competition for capital is just much more pronounced. Where in Japan, over the past couple of decades, that money was rolled out into international markets. I think over time you'll start to see that repatriate into Japan. We haven't seen much of it yet, but there's still a pressure point there. And so I do think this crowding out story is a real story.
I have to get your thoughts on the Fed. We got the minutes from the last meeting, kind of confirmed what I think we all knew. But it does kind of raise the stakes to a certain extent as to what the next couple of meetings look like and whether we should be talking about the potential for rate cuts or whether maybe there is still an argument to be made for, I said rate hikes, excuse me, or maybe an argument to be made for rate cuts.
Yeah, there's a lot of conspiracy theories going on because the more pressure you put on the front end, there's a clear desire to have more T-bill issuance. That puts more pressure on the Fed actually keeping rates where they are or moving them down. So I'm not convinced that's the story, but ultimately, as the Fed raises rates, as we have more in T-bills, that costs more to the U.S. Treasury, right? So there is that dynamic there, but I think it's separate, but time will tell.
Do you think we're going to see any kind of flattening of the curve, any material flattening of the curve?
Well, I've been calling for a curve steepener for years now. I had love for a little bit, but I think probably curve flattening here over the near term is the right trade.
You're calling for the 10-year to reach 4.6%. What would break if that happens? Stocks, credit, the economy, or nothing?
Well, so a key piece of why interest rates are where they are is the nominal growth story, right? If you look at the fundamental piece, right? If you look at earnings as a proxy of growth, which is why stocks are doing so well, you could quibble around the valuations, but the fundamental earnings driver piece is quite strong. That's in part why yields are where they are. And I think that's a good story, right? The less good story is the uncertainty premium, the inflation concerns, and alike. But ultimately, the nominal growth story is a fantastic one. And I think that is why risk assets are doing as well as they are. And that makes sense to me. That's how it should be.
And I mean, we've seen the economic data, and it's kind of, I think it shocked some people because, I mean, there was a lot of sort of a gloom and doom a few months ago after the war started in the Middle East, and even a year ago when it was the whole tariff thing. And you've seen an economy remain resilient, partly because of the AI boom, but consumer spending has held up despite, that one-off retail sales report we got. So you're pretty confident, not only for the rest of the year, but even going into 2027 about the economic backdrop?
I am. Yeah. What I am, the worry is the single factor model aspect of it, which is to say AI, right? So that drives, not only the spending, which is 1.5% of GDP, but it also fuels equity prices, which fuels the wealth effect, which fuels kind of the other piece of it, right? And so what I fret about, or what I worry about, is if you start to see a pullback on the AI side, what kind of effect will that have? That's kind of the unwind effect of not only on the capex spending side, but also on the wealth effect side. So that's what I worry about. It's not a high probability event, but that is a tail risk for sure.
What about credit risk? They're historically tight. Do you think that investors are getting paid enough to compensate for their risk, or maybe not really?
I think credit is telling you that the fundamental story is a good one. So I think it fits. I think it all fits. At the same time, as a credit investor, I don't necessarily love credit, right? Because I'm not getting paid for the tail risk. At the same time, what we're seeing on the credit side is incredible dispersion and opportunity. So while the kind of the index levels are really tight and uninspiring, the dispersion's quite wide. This AI build-out is a treasure trove of relative value for bond managers such as ourselves. So it's kind of a paradox where on one end I think credit is too tight and I don't want to own it in a kind of a beta way, but from an alpha generation standpoint, with dispersion and the AI build out, it's tremendous opportunity.
All right, Greg, great to have you here. Gregory Peters here, one of the best in the business, co-CIO of public and private fixed income at PGIM. Now, coming up in just a bit here on The Close, we're going to catch up with the former CEO of Walgreens Boots Alliance, Roz Brewer. We're going to talk about her career and what might be next for her in the C-suite. That's coming up next right here on the Bloomberg. This is The Close. Take a look at the broad markets here, Isabel, and the S&P 500 bouncing back mildly off of 3 straight days of losses. It raises a lot of questions as to what the next catalyst might be to take the market to the next level.
Probably it's another Treasury move, which is always unexpected. I mean, this really took us by surprise today. But I want to talk about some movers who remain. Estée Lauder, I want to single that out. You had a great chat with the CEO today, and they had really a great earnings, and they ended 3 straight declines in annual revenue. Yeah, 4 straight quarters of organic net sales growth, and the guidance going forward. And I think the key word there is organic, the idea that it won't necessarily be driven by M&A. But how about Moderna? Oh yeah, look at that. Stocks up almost, that's triple, oh my gosh, it's almost 200%. That's, that caught me by surprise. Yeah, we're going to talk about TJX in just a second, set you up for what to talk about with Walmart tomorrow. And we're going to talk robotics when we come back here on The Close on Bloomberg. SoftBank. It's putting $200 million into the construction technology startup Gravis Robotics. The investment comes following Bloomberg reports that SoftBank may be considering an acquisition of the Zurich-based firm. Ryan Luke John joins us right now. He's the CEO and co-founder of Gravis Robotics. Hey, great to have you here, man. First, let's start off with that $200 billion, one of the largest Series A's that we've seen in this space. And more importantly, I guess what I thought was interesting was there's no co-investor here. This is SoftBank going alone. What is Masayoshi-san whispering in your ear that he had the confidence to write you a check for $200 million?
Yeah, I think SoftBank is absolutely doubling down in this physical AI space. And they're seeing, I think, as you brought up in the previous segment, right, there's this big boom going on in AI infrastructure. And where we come in is we're essentially that first mover on the ground, right? We're bringing in the autonomous excavators that are accelerating that earth movement, and they're accelerating that build out literally of physical AI infrastructure. But at the same time, we're seeing a spike in demand across all kinds of infrastructure, right? This is roads, this is quarries, this is the mines extracting the minerals and the metals that are being used to make the products, right? So where we're really delivering is productivity across that ecosystem. And I think that broad impact of, automating essentially things like excavators and wheel loaders, these machines that you see on construction sites that are, construction itself being 13% of the GDP, it's a massive impact that we can have by delivering productivity in this space.
And just to be clear for our viewers, I mean, you're basically retrofitting existing excavators and equipment to sort of be either, if not fully autonomous, semi-autonomous. Is that right?
Exactly. So we're putting a lot of things like LiDAR, cameras, computers onto excavators to give them the perception to kind of understand, for example, the safety of the environment, but also to do things like surveyors do, like measure using a 3D scanner, the shape of the terrain, to be able to dig very accurately, but also very efficiently and very productively in those construction environments.
What's the demand, though, for a retrofit in this space versus an actual, custom, purpose-built autonomous type machine?
So, excavators are a beast of their own, right? They're a complex hydraulic machine, and the market is very, very broad. There's a lot of OEMs in it. So, if you look at, for example, the top 3 OEMs, they only account for about a third of the overall market share. So you have a really long tail of brands doing maybe 3, 4, 5% market share. And we've been able to go on a dozen of those different brands, right? And what's really important there is it's giving construction companies the choice of machine to use. These machines last oftentimes more than 5 years. So they're not having to go out and rebuy a new piece of equipment. But at the same time, I think you have to consider that a lot of these construction players, they're loyal to their local service providers who've been able to come out, show that same day they can replace a part, they can get that machine up and running without delaying the job. And I think if you've spent time in the heated environment of a construction site, you know that the last thing you want to do is stop or block productivity. And that's what gives a lot of loyalty to different brands, but also to our own solution.
Well, that's what I'm curious about, though. I mean, we talk about, you're not naming them, but I assume you're talking about Caterpillar and Komatsu and a few others. I mean, they've had autonomous mining trucks, I know, for quite some time. So I guess the question is, what stops them from building, sort of the rack themselves and basically cutting out Gravis?
Yeah, so I think, one important thing to note is we do work directly with a lot of OEMs. We work with companies like HD Hyundai and others, and we're really working to bring that technology out in a very efficient way to customers. So we see, though, that when you mention, for example, the mining trucks, those are vehicles which they have to just drive essentially from point A to point B. And they have one requirement, which is don't crash into anything, right? If there's a rock in the road, if there's a pole, if there's a person, you want to hit the brakes. An excavator or a wheel loader, any machine that has an arm on it, it's actually intentionally crashing into an environment. It's changing that environment as it navigates through it. And very importantly, the real ground is rocky, it's frozen, it changes in an instant from maybe soft loam to solid bedrock. And what we're able to do is use learning-based control to essentially teach these machines to feel the earth, which lets them dig very productively, lets them take a full scoop of dirt, which when they dump that full scoop of dirt using a very repetitive robotic, fast motion cycle, we're able to actually accelerate the amount of earth that can be moved in an hour on these, heavy repetitive tasks.
Well, in addition to sort of the competition, though, from the established OEMs, I am curious, Ryan, just about this idea of some of the newcomers. On the same day that we learned about the SoftBank's investment, Bedrock Robotics, which was built up by a couple of veterans of Waymo. It's backed by NVIDIA and I believe Capital G over at Google. They're saying their excavators are fully autonomous. Is that, and live right now at several sites, is that a direct competitor to you?
So I think what we're seeing right now is the demand in construction has never been higher, right? So what we're very excited about is to have multiple competitive players, whether that be OEMs or other startups working in this space, who are going to work to deliver a competitive, safe and productive product to customers. And that's just going to accelerate the entire ecosystem. I've spent my life, committed to the built environment, and I'm really excited to see players coming in and being able to push. I think where we stand out is a couple things. One is that we have a product which delivers full autonomy, but it also exposes all that information that the robot uses to operators. So it can be used like a co-pilot to show them where to dig, where not to dig, if there are people coming into their working environment. So we really let operators gradually adopt autonomy at their own pace. Yeah. The other thing is that because of a learning-based system that is trained heavily in simulation, we're literally training in lifetimes of construction operators' experience. So we're putting in essentially billions of cubic yards of earth movement in those simulation-based models, and that's letting us exceed an average operator when we deploy these systems. So we're seeing up to 30% or even sometimes 40% of expectations exceeded when we're doing that excavation. Yeah. And then that last part, as I mentioned, this fragmentation of the market, you've got a lot of different OEMs, and we're the only player who's really been able to show that we can go on pretty much any machine, and we can deploy that same learning-based control on a 10-ton Yanmar as we can on a 50-ton Caterpillar.
All right, I do have to end this by just circling back to SoftBank, and really, and more importantly, Masayoshi Son. He doesn't cut checks like this just willy-nilly, and his expectations for growth are pretty ambitious, and we've seen that in the past. I mean, they expect big scale or bust, and I guess the big question is, are you prepared for that? Are you going to be like the next ARM? Are you going to be the next WeWork? Where do you fall in all this?
We're of course really excited for very big scale, and I think what we've shown is a commitment to our customers to prove this out in real environments. We're operating in 4 continents right now on the biggest variety. We've got customers, with half a dozen machines. We've got customers coming back to us for more. So we're really, really excited, and we're doubling down also on distribution relationships. We just announced last week an $8 million project to bring actually a turnkey rental solution together with the largest operated rental company in the UK out to customers. So we're really using this opportunity with SoftBank to deliver autonomy and use also this AI build out to slingshot our capabilities to be able to deliver to all the other kind of construction domains which need this, right? Build out housing faster, build out renewable and resilient infrastructure faster. We see this kind of AI boom as a massive opportunity for autonomous construction.
All right, great to have you here. Ryan Luke Johns there, the CEO and co-founder over at Gravis Robotics. Meanwhile, we are getting some earnings crossing the wire. This from beauty company Coty. We should point out, in the most recent quarter, if you X out the foreign exchange boost, on a like-for-like basis, net revenue was down in the quarter, down 1%. And by my count, that's a 7th straight decline. But we should point out that is the smallest drop in about a year and a half. The shares in the after-hours trade down by almost 7%. We'll be back in a moment. This is Bloomberg. Rosalind Brewer, she's built a storied career at some of America's most iconic brands, Sam's Club, Starbucks, Walgreens. I had a chance to sit down with the former CEO at Walgreens Boots Alliance at our Bloomberg New Voices event out in Martha's Vineyard. I asked her a lot about the leadership lessons and some of the pivotal moments that shaped her career, from the lab floor at Kimberly-Clark 30-plus years ago to the CEO suite at Walgreens just a couple years ago. Take a listen.
I joined Kimberly-Clark as an organic chemist. I worked in polymer science and then in manufacturing. And really, that's all I wanted to do. I just felt like I was a scientist, right? But, corporate introduced me to something. The business showed me that I could work in M&A. I moved over on the M&A side of the business. And after working in M&A, I ran some of the new companies that they purchased. And so I never looked back to the lab, and the history is there. But that was never the plan.
Yeah. Did you learn something from the lab that sort of was applicable to your future career as a business leader?
I did. First of all, being a chemist, you are just deeply embedded in the analytics. And, one of the things that I learned more than anything is how best to problem solve. And I learned that in the lab, and it's relevant when you're sitting, in a business setting. And I think the work that I've done in my career on transformation is around looking at the problem and flipping it on its side and then solving it. And I will say that I gained that from my time at Spelman and then my time as a chemist.
You left Kimberly-Clark.
I did.
And you went to Sam's Club?
I actually went to Walmart stores, and I ran operations ultimately for about 50% of the country for Walmart U.S. stores. And then I was made the CEO of Sam's Club, a division of Walmart.
Well, I am curious about that because when I looked at that, I mean, you were basically running a division at Kimberly-Clark.
Correct.
You go to Walmart. Was that a promotion, or was that more of a step down?
It was actually quite a demotion.
Yeah.
My title was global president when I left Kimberly-Clark. And I knew I wanted to create a new skill set. So when I joined Walmart, I took a vice president's role in operations, running the stores in the state of Georgia. And it was tough work. I had to learn retail, but I was actually with one of the best retailers in the world. And I was in this role for about 4 months, and I took over the Southeast operations, and then over a short period of time, I ran half the country for Walmart stores.
For people out there who are looking at their careers and they're looking at new opportunities, what does it mean to maybe take that step down with the idea that maybe that leads to a step up in the future?
Yeah, I mean, I think you have to constantly look at your skill sets and the deficits. And some individuals don't want to recognize that there's still learning to be had, that that you're not as good as you think you are, and you do need to expand. And I looked at myself and said, you're not growing anymore. And I had sat across the table from Walmart in my role at Kimberly-Clark, supplying them diaper materials and finished product. And I admired retail. And when I joined retail, the one thing I learned about it, it's about operations in detail. And that was my background. And so I did take a major step back.
You eventually retired from Walmart, and that was a pretty short retirement. I should put that in quotation marks. You were only retired for a few months. You ended up on the board of Starbucks, and then they tapped you to be COO. Did you know that was coming?
I had no earthly idea.
Yeah.
It was only in my second board meeting when I got called. I'd left a board meeting and they're calling me back. I actually thought I left like an umbrella or something. I was like, are we done with this board meeting? What's going on? And they were calling me back to say would I be interested in joining the new CEO as his chief operating officer. And when that was described to me, I was thinking, this could be interesting. I do like to operate, and I decided to first of all, maintain my seat as a member of the board of Starbucks and take the chief operating officer role.
You did, and I could say that at least based on how Wall Street viewed things, it was incredibly laudatory, your time there. There, of course, was the famous incident back in 2018 where the two gentlemen in Philadelphia store, and you shut down the stores, all Starbucks stores.
All of them.
For an afternoon of diversity training, and my understanding that training still continues to this day. But I'm curious, that was 2018. That was pretty bold, because this is before 2020 when every corporate
we lost money.
Jumped on the bandwagon. You did. Do you think a major company would make that call today in 2026?
I have to be honest with you, I don't think so. I think that it would get negative public attention. I think we actually ran the risk of that in 2018, quite honestly, but we knew that we needed to do that. But today, I think that that would not happen, quite honestly, and it's quite shameful that that won't happen, because there are still instances where bold moves like that are needed, and even probably more required today.
You did leave Starbucks. Most of the talk, including Bloomberg's own reporting at the time, was that you were kind of the heir apparent. That was kind of the view to Kevin Johnson. Why did you leave?
You know, at that time, there was a lot of work happening at Starbucks in terms of the founder, Howard Schultz, and his ascent to a professional role in politics. And I actually considered, you know, what should I do at this point? And quite honestly, Walgreens came and knocked on the door, and I had some decisions to make. And I liked the opportunity of pharmaceuticals. I liked the opportunity to be in a new category in space, so I took the opportunity.
Did you get a fair shake at Walgreens? I mean, you're on there for a couple of years.
Yes.
You inherited a program, a strategy from the primary owner, Stefano Pessina, and I am curious as to whether you ever felt true ownership of what the plan was to turn Walgreens around.
You know, I came into that opportunity with eyes wide open. I knew clearly what I was approaching. And in that respect, I had learned a lot about turnarounds. And if you're aware of the task in front of you and you power yourself up with strong people around you, your chances of winning are very strong. We did all those things. During COVID, I joined during COVID, first of all. And joining during COVID, I knew that usually when there is a crisis, there is the best chance for change to happen. And that's in fact what we did. We brought technology into Walgreens in order to put 70 million shots in arms. And we did that because we were able to do two things. We managed the cold chain process of Pfizer through distribution to retail to 70 million shots in arms. That's the work that I learned as an operator.
And that is Roz Brewer, of course, the former CEO of Sam's Club, the former COO over at Starbucks, and most recently the former CEO over at Walgreens Boots Alliance. That was part of our New Voices event that Bloomberg puts on around the globe this year, or I should say this month. We held it for the first time out there in Martha's Vineyard. We'll be back in a moment. We're going to continue talking retail, and we're going to set you up for those earnings out of Walmart tomorrow morning. This is Bloomberg. Some breaking news on the tariff situation between the U.S. and Canada. We're now learning, based on Bloomberg reporting, that the President of the United States is poised to reduce tariffs on automobiles from Canada to 15%. That would be down from 25% of tariff that the President put on foreign-made cars and trucks last year. Of course, there's been a lot of back and forth with regards to the U.S. and Canadian negotiations. We'll update you on any additional information that we get on this. And don't forget, Joe Matthew and the Balance of Power team will be up at the top of the hour with some more information as well. Meanwhile, we do want to turn back to the markets and turn back to earnings and turn back to the retail sector. We're going to hear from Walmart tomorrow, obviously the granddaddy of them all. I don't know where expectations are. Well, we're going to find out. Jharrone Martis joins us, Director of Consumer Research over at LSEG, to talk about what to expect. Expectations for roughly about 3.5% to 3.7% comp sales growth. That seems pretty good to me. Is that what you're expecting?
Actually, we're even looking for a little bit stronger, 3.8%. Revenue up 6%, earnings 9%. It's important to look at all the components. I think that it will be a good quarter in overall for Walmart. But in addition to its scale and proximity to the consumer, one other advantage that Walmart has is its high margin businesses like advertising and membership, which are expected to grow about over 25% for the quarter. It's these high margin businesses that really give Walmart the financial power to do the everyday low prices.
So that's having a meaningful impact on the business overall?
Yes, it is. And that's actually what's helping it, you know, because last quarter we did hear from Walmart, you know, that they're also being hit by higher fuel prices, energy, and therefore the bar actually has been set a little bit lower for Walmart. But given all these circumstances and seeing how much membership and even advertising is expected to grow, this is really what's making it a slightly more difficult for traditional retailers like and supermarkets to even compete with the likes of Walmart.
We'll talk about the competitors. I mean, we heard from Target earlier today, and I know it's a little bit of a different story with the turnaround. Are you buying into that turnaround story?
I think it's getting its groove back, yes, especially because what really stood out today was the traffic number. So revenue grew over 5%, and that can be obviously attributed to higher prices. But the fact that traffic grew 3.6%, this is telling us that the consumer is going more to the stores and actually purchasing more.
But what exactly are they buying? And I really am curious to hear what Walmart has to say, because there's been a lot of anecdotal evidence that people are spending, but they're either doing two things. It's kind of the barbell. They're either buying the absolute necessities they need for back to school or whatever, or maybe they splurge on that one unique item or something, but it's not necessarily the fill your basket
No, but what Target is doing very well is when you walk into the store, I don't know if you've been there, they've really remodeled it. So you walk in to buy two things and you're actually then purchasing additional things. Another thing that's really helping them this season is their back to school items that are lower. 95% of the items are lower than the prices that they had last year. And this is crucial because right now, in a collaboration with Centric Market Intelligence, we actually discovered that backpacks, footwear are all significantly higher than they were a year ago, or even going back the previous 6 years.
Well, I mean, they're still not on the same value scale as a Walmart, at least certainly not by perception. I am curious with regards to Walmart specifically, and the idea that they weren't necessarily direct competitors in a lot of ways because they were in much different geographies. However, with the build out of the e-commerce business that Walmart has done pretty well here, are they more of now a direct competitor, not only to Target, but to Amazon as well?
Well, the upper hand that Walmart has compared to Amazon is its proximity to the consumer. So 90% of the U.S. population lies within 10 miles of a Walmart. So that's huge within itself. And Amazon just doesn't have that. Another thing that we've noticed this earnings season in general, and this is also why Target is doing better. Target told us that they had a 25% increase in same-day delivery. Same thing with Home Depot and Lowe's. Home Depot and Lowe's did not do well in general, but their e-commerce grew double-digit comps for both of them. So what we're seeing is that agility, speed, consumers are all about instant gratification. They're being very selective this earnings season where they're spending, but also if they can get that convenience factor, that's where we're seeing all the strength this earnings season.
All right, Jharrone Martis, Director of Consumer Research over at LSEG. Walmart earnings out before the bell tomorrow. And meanwhile, after the bell tonight, keep an eye on Moderna. Those shares closed higher by 170+% in the cash session. They're still moving higher in the post market. This on the back of that late stage study for a vaccine related to melanoma. Balance of Power is up next, right here on Bloomberg.